Well, thank you very much, Lionel. That was a great welcome. We often like to leave the dates out. That grandfather thing sounds kind of fun. Actually, it is kind of fun, but makes me feel my age. But anyway, a wonderful introduction. Thank you so much for that, and for all of you to come today. Je suis très heureux de me joindre à vous aujourd'hui. Merci de votre invitation. Et comme je me trouve à Saskatchewan, je vais vous parler en anglais aujourd'hui. Toutefois, il me fera grand plaisir de répondre à vos questions en français et en anglais, bien sûr. So it's absolutely a great pleasure to be back here with STEP. As Lionel mentioned, we're old friends. When I was chief economist at EDC, I'd do the Let's Talk Exports presentation with STEP, partnered with STEP each year. And got to meet a lot of great companies from the region, and I see a lot of old friends here today from my EDC days. Also met some new friends. Nice to meet you all. I understand there's a bunch of students here from Edwards School of Business who do this. There you are. Good to see you. Anyway, STEP is doing a great job, and I applaud their efforts to develop exports from this province to the rest of the world, and not just the United States, but all over the world, one of their landmarks. And as I'll get to later, Canada certainly needs those exports. Now, from my vantage point at the Banque du Canada, I have to take a broad view of the Canadian economy as a whole. But depending on where you work or where you live, your personal sense of how well the economy is doing will vary. And from one region of Canada to another, from one sector of the economy to another, we're seeing fundamental differences in the demand for our products, in employment, in wages, and of course in housing. In fact, we're seeing markedly different rates of economic growth in these various areas. Some sectors and some regions are hot, and some are not. This shows up most tangibly in employment and housing. So in a place like Fort McMurray, it's fairly easy to find a job, but it's hard to find a place to live. Well, in other cities, the reverse is true. And the time I have with you today, what I'd like to do is talk about what's hot and what's not, and talk about the forces that are fueling the economy's heating and cooling systems. My job, I think, is to pass on some of our analysis so that you can use it to make informed, better, if you like, decisions, both financial and economic, for yourselves and your families, your businesses, and of course your futures. So first of all, what's hot? Oil. One of the most important forces powering Canada's economy today is the long-term strength in global prices for our resources. For Canada, of course, oil stands out, and we have the world's third largest reserves of crude oil. By the way, we're also number one in potash production. What this means is that it's money in our pockets. Now, in technical terms, and economists always have technical ways of describing everything, you've heard that before, we call that a positive terms of trade shock. That may sound shocking to you that we would have a technical term for this, but in non-technical terms, it's a gift. And as the value of the resources that we export goes up, and as the value of the products that we import either remains low or rises more slowly, this means our terms of trade are improving, and more wealth flows to Canadians. So I'm going to put it to you this way. You've got an old box of hockey cards in the basement, right? I think everybody's got boxes of hockey cards in the basement. Now, what if in that box you've got a Chris Kunitz card from his rookie days? And now that the Regina native is an Olympic gold medalist, two-time Stanley Cup winner, that card suddenly is worth a lot. And so now, after lunch today, you have the incentive you need to go downstairs and dig it up. Well, it's the same thing with a terms of trade shock. Okay, since 2002, Canada has enjoyed the benefit of an almost 25% rise in our terms of trade. With the average world price of oil over the past decade more than double that of the previous 30 years, Canada's resources are suddenly worth a lot. And we have the incentive to go down and dig them out of the ground. And that's what's been happening. Now, higher oil prices have stimulated oil production in Canada, magnifying the benefits from this improvement in terms of trade. This is particularly true, of course, in Canada's vast oil sands, where the higher prices have made them economically viable. But to step up production requires more workers and, of course, more money. So where do they come from? What draws that in? Well, the economy, as it happens, has natural market mechanisms that help. With the higher prices that these sectors command on the world markets, profits and job markets and wages heat up, and that attracts more investors and, of course, more workers. And as people earn more, well, they spend more. And as this workforce grows, they need more of everything. You can name it, all the way from Tim Hortons to more pickup trucks. And this leads to more jobs and higher wages in other sectors and other regions of the economy, so actually everybody benefits from this gift. Now, importantly, people move to where it's hot. And we all know that. We've just been through the worst winter that most of us can remember. But as a share of GDP, investment in mining and oil and gas extraction has basically doubled since 2002. And as companies step up their investments, they set off a chain of events that draws people in. So over the past 10 years, about 250,000 people, net, roughly the population of Saskatchewan, have moved from other provinces to Alberta. Last year alone, net migration to Alberta from the rest of Canada was nearly 45,000 people. Saskatchewan as well has had more people move in than out for the same reasons. So between 2006 and 2011, about 1 in every 5 Saskatchewanians, I hope that's a real word. I'm from Oshawa, and we never say Oshawanians. We just say we're from the Schwa. But anyway, about 1 in every 5 Saskatchewanians was either a newcomer or had moved a long distance within the province. So for all of Canada's workers, this movement, this is a sea change. And while Alberta and Saskatchewan may be net recipients of people, there's still significant gross movement of people into and out of the cooler provinces and the cooler sectors. And the fact is there's lots of jobs being created all over the country, demonstrating the economy's ability to respond to these changing circumstances. So people are crossing the country not just for jobs, but also for better wages. So no matter how you cut the data, they consistently show that workers in Alberta and Saskatchewan, Newfoundland and Labrador have seen their wages go up much faster than anywhere else in Canada in the last few years. Now, interestingly, in part because of this movement of people, gaps in the unemployment rates among the provinces have not widened in response to this terms of trade shock. Rather, they've actually become smaller than they used to be. So the growth in job opportunities in hot areas is almost matched by a net migration of workers out of provinces where the opportunities are less plentiful. So Canada's labour force is demonstrating remarkable flexibility through this, as workers from across the country move to find good jobs and good pay. However, this is not to say that's easy. In places where it's hot, they're scrambling to keep up with the demand for housing. Here in Saskatchewan, next door in Alberta, many more houses proportionately are going up than elsewhere in Canada. Furthermore, the cost of maintaining a home in these provinces has increased by far more than anywhere else. So for people outside the hotspots, it's a really big decision to move across the country. The people moving to the hot economies are leaving other areas of both the country and of the economy, and they're taking income and potential with them. Now, this sort of upheaval can be difficult for the regions and the sectors that are losing the workers. And for families, the long-distance relationships it creates can be tough. But in the long run, we are all better off with this positive terms of trade shock. As I said, it's a gift. While different regions and sectors adjust differently, and while these adjustments can be painful, they allow us to maximize the benefits of our rich energy endowment, and ultimately, everyone gets the gift. Now, overall, Canada's gross domestic income, the GDI, which is a measure of the purchasing power of all income generated by domestic production, is about 7% higher today than it would have been without the improvement in the terms of trade since 2002. That's a lot of money. And when we break this down by region, big benefits are obviously accruing to the 3 oil-producing provinces. But those who suspect that gross domestic income is falling elsewhere will have to think again. In fact, everywhere in Canada, gross domestic income is higher than it would have been without this improvement in the terms of trade that I'm talking about here. Now, for Canada as a whole, where the terms of trade go, the loonie follows. International investors buy good news stories. And when they buy Canada's good news story, the value of the Canadian dollar goes up. As a consequence, our terms of trade and the dollar tend to move together, not necessarily always in sync. So to me, it's like walking a dog on one of those leashes that stretch out and snap back. Now, you might hope that the dog will stick by your side, but in reality, the dog is always off in all directions. Now, if you were to look at the footprints in the snow, yours might be a nice straight line through the park, but of course, the dog's tracks are zigzagging all around yours. But at the end, that footprint arrangement might look like an economist's chart, but when you leave the park, the important thing is you're still both together. So that's about what the relationship is between the terms of trade and the Canadian dollar. It's loose, but it's dependable. And it's also how the gift of a positive terms of trade shock gets spread even further. So a stronger Canadian dollar gives the whole country greater purchasing power on global markets by bringing down the Canadian dollar prices of imported goods and services. That means cheaper televisions, cheaper trips, cheaper tools. Now that's good for Canadian consumers and for companies that buy machinery and equipment. And yes, it's true that for some businesses, the stronger dollar also may reduce their ability to compete in world markets. And I'll speak more about that in a minute. Now, it's important to note that the terms of trade are not the only thing that affects the exchange rate. Other forces, of course, are important from time to time, and in particular, the U.S. dollar. So in the post-crisis period, the U.S. dollar tended to be weak against many other currencies, including ours. But in recent months, with the U.S. economy showing signs of regaining its momentum, the loonie's strength has diminished, coming down from its post-crisis peak. So far, I've been focusing mainly on the hot side of Canada's economy. So what's not hot? Well, non-energy exports. In the manufacturing sector in particular, here the story is not so cut and dried. Now, as I mentioned, the strengthening Canadian dollar in response to this improvement in the terms of trade contributes to the competitiveness headwinds faced by non-energy exporting companies, especially manufacturers. Added to this was the pain inflicted on manufacturers across all advanced economies by the Great Recession that followed the financial crisis. Here in Canada, the crisis lowered the temperatures of both the energy and manufacturing tracks of our economy. But due in part to the magnitude of the hit felt south of the border and to the severe impact felt by U.S. sectors, very important to Canadian manufacturers, including residential housing and auto production, the crisis was particularly hard on Canada's manufacturing exporters. Many manufacturers and manufacturing jobs simply disappeared. For the sector as a whole, the recovery has been a long time coming. Now, together, these two shocks, the terms of trade shock and the crisis, have really walloped Canada's manufacturers. But now that the world economy is beginning to get its recovery underway, this will relieve the pressure of the shock of the crisis. But it's important for all of us to realize that the forces relating to the change in the terms of trade will remain. They'll continue to be felt even as the global recovery continues. So one shock is going away, the other remains, and will continue to exert forces on the economy. Competitiveness challenges have prompted many Canadian manufacturers to become more productive. Some of them have streamlined their activities, introduced new products, new services, have entered new markets, have invested in cost-saving technologies. Some have outsourced product fabrication, but they've invested in new product development and sales and service for new markets. Now, we've seen gains in productivity among those manufacturing subsectors in which Canada has natural advantages. This would include things like primary metals or wood products and paper and food. Since 2002, the greatest increases in manufacturing output per worker have occurred in these industries. And we all know that Canada is an export-driven economy. Growth since the crisis has been fueled by policy, not by natural forces. And we need our economy to shift gears and for exports to lead again. The importance of manufacturing to the economy, and in particular manufacturing exporters, and the growing wedge between our export performance and foreign demand led the bank recently to dig a little deeper and to try to understand better the dynamics of what's happening under the surface. So to do that, we broke down the non-energy export sector into 31 subsectors and investigated at this much more detailed level. So we've discovered that for many of our export subsectors, exports have actually been behaving broadly in line with the fundamentals of foreign activity. In some cases, even better. For them, business is clearly heating up. Subsectors that are expected to thrive as the U.S. investment picks up steam includes machinery and equipment, building materials, commercial services, aircraft and aircraft parts, others. Other strong subsectors that are poised to heat up include pharmaceuticals and plastics and metal products, and importantly, travel and tourism. Now, some of these subsectors are expected to benefit also from the recent decline in the Canadian dollar and, of course, stronger U.S. activity at the same time. And taken together, these subsectors that look most promising constitute about half of Canada's exports. So we're hopeful that as temperatures rise, these industries will help drive the recovery in Canada's exports overall. Now, other subsectors, however, are still coping with these competitiveness challenges, which have been developing actually for a long time and weigh on their ability to benefit from stronger growth abroad. So these include auto and truck makers, food and beverage suppliers, chemicals. Because their issues are longer term, the recovery for these groups is going to be slower, even as they could be helped by the recent decline in the strength of the Canadian dollar. Now, this analysis has given us a much more granular interpretation of the export picture, and it gives us more hope for the recovery of our non-energy export sector. However, it still implies that the wedge that we've observed between exports and foreign demand will persist to some degree. And while there's more restructuring of the Canadian economy in store, we expect a gradual convergence between the growth rate of Canada's exports and the growth rate of foreign demand. Now, the bank is looking to industries that are out in front in terms of their knowledge, their technical expertise, or production advantages to lead the growth in Canada's non-energy exports. For instance, some of those companies supported by Innovation Place here in Saskatoon. We're looking at industries that have posted solid performance over the past decade, and more frankly, industries of the future, industries that we may not even be able to identify currently. Chances are that our big bursts of growth, both in output and productivity and in new job creation, will come from brand new companies with brand new products, brand new services. But we know that this sort of process takes time, and we'll need to be patient about it. Now, in order to achieve sustainably stronger profile of export growth, we simply can't rely solely on the U.S. market. There's no doubt that an improving U.S. economy is good for Canada, but the growth potential of emerging market economies is projected to be about 4 times that of the world's advanced economies. Ultimately, in addition to capitalizing on the stronger growth of these markets, diversifying our export markets will help reduce the risks associated with weakness in just one export market. And we can do this now, as folks at STEP well know. But as our various free trade agreements fall into place, we'll be able to do so even more effectively. And I know Minister Fast was talking about this just yesterday. Overall, we remain hopeful that rising global demand for Canadian goods and services, combined with the continued high level of oil prices, will stimulate business investment in Canada and shift the economy onto a much more sustainable growth track. Now, consistent with this view, manufacturers interviewed by the bank in our spring Business Outlook survey indicated that in an effort to improve their competitiveness or to create opportunities for growth, they're planning to increase their investments in machinery and equipment. Now, such intentions seem to be somewhat more prominent among small and medium-sized firms and, of course, among export-oriented firms. As well, Statistics Canada's recent survey of private and public investment intentions also shows manufacturers across a broad range of subsectors are planning to increase their investment. So I'm encouraged by these intentions. Now, with Canada's stronger terms of trade and with our healthy business environment, with our ability to innovate, the future of Canada's manufacturing sector is bright. But just as your favorite maple tree looks different every spring, the manufacturing sector will evolve, at least on the surface. For instance, we can expect some parts of the manufacturing process to move offshore to lower-cost venues. In this respect, we have to remember that manufacturing is not just fabrication. It involves much more. Prior to fabrication, there's research and development and engineering and design. Pre- and post-fabrication activities are high value-added services that reward skilled workers with high wages. But at the same time, our rich resource endowment makes Canada a natural place for manufacturers of food or fabricated primary metals and forestry products. Hot or not, where does monetary policy fit in? Well, in effect, at the Banque du Canada, we make sure the big picture is balanced, and we let these forces that I've identified work themselves out beneath the surface. Our key contribution is to keep inflation on track. However, even though monetary policy does not address sectoral or regional issues and instead is designed for the economy as a whole, the analysis that I've described here feeds critically into our policy decision-making. We simply need to understand these things before we can put together a complete picture. Now, our forecast is that as a result of higher consumer energy prices, total inflation will rise in the next few quarters. It's already started. Now, these increases will have, by definition, transitory effects on trend inflation. A year from now, those effects will drop out of the numbers. That's just the way they're made. But in the meantime, what is crucial to the underlying inflation story, is that we are starting from a low inflation rate, not far away from 1%, as opposed to our target, which is 2%. And that's why we say that the downside risks to inflation remain very important, because they would have the potential to push inflation significantly further away from our 2% target. Now, if we ask ourselves where those risks might come from, obviously our story hinges critically on the outlook for Canada's exports. We already have what looks like an emerging soft landing in housing. So it's crucial that at the same time there's a pickup of momentum in our exports, which we believe will then be followed by a pickup in business investment. Now, these two shifts will put our economy on a much more sustainable growth track. However, if for some reason the export recovery were less than what we're predicting, then total inflation, having gone up to close to 2%, will simply drift back down to converge with core inflation, which is perhaps around 1%. And that's because the output gap that pulls inflation down will be just as big as before. Now, either way, it should be clear that we're still a long way from home, as it will take until early 2016 to get underlying inflation back up to 2%. So our economy has room to grow. And when we do get home, there's a growing consensus that interest rates will still be lower than we were accustomed to in the past, both because of our shifting demographics and because after such a long period at such unusually low levels, interest rates won't need to move as much to have the same impact on the economy. So last week, reflecting this analysis, we maintained the target for the overnight interest rate at 1%. Well, it's time for me to wrap up. Frankly, we can't be 100% sure that oil prices will stay high indefinitely. We have a forecast, but the circumstances are global, can obviously change. What's crucial is that the Canadian economy maintain this ability to adapt to shifting temperatures. Diversifying our export markets is important to our future growth and our resilience. And just as when you travel from one part of Canada to another, the weather can be dramatically different. Hot in the Okanagan, bone-chilling cold here, and moderate in the Maritimes. Local economies can cover the gamut, from hot to not. And we're fortunate that we can see these shifts in economic temperatures as they occur. And the key to is having an economy that is flexible enough to sustain the shocks and then adjust to them smoothly. And the more we know about the shocks and these adjustments, the better prepared we are and the better able we are to benefit from everything that this great country of ours has to offer. Thank you very much.
So, ladies and gentlemen, if I could, I ask you to grab a microphone and feel free to ask any question of the Governor that he hopefully can answer. Before we do that, Governor, I thought I'd ask you a question that in your past life with EDC you might have been more comfortable in asking, but it's the issue of currency fluctuation. So over the 5 or 7 year period, we've probably gone from 65 cents to $1.05, now we're at 90, 91. You know, marginal change is easy to manage, and our people are sophisticated, they know how to do that. But something new has entered, and I'll give you the last 8 months. Kazakhstan devalued their currency by 20%. Last summer, Indian rupee devalued, not devalued, but went down 38%. Very difficult for us to manage. Any thoughts about that whole process and where, first of all, the Canadian number will go, and then this international challenge that we have that seems to be broader than what we're used to seeing?
So that was a lot of words to cover up a question, which is, where's the dollar going? Right? You all heard that, right?
Yeah.
Next question. No, seriously, next question.
Fair enough.
Okay, well, I will comment just in a roundabout way, because as I mentioned, the most important thing that has happened to us is this 25% increase in our terms of trade. And that's not just oil, but oil is the most correlated with it. But it's true for a broad range of commodities. We believe there's a commodity super cycle. How many people believe in that? You know, there's a lot of growth to come. You know, yeah, potash might be a little soft in price right now, but we know that the longer term way is up and so on. So all those things kind of come together. And so the terms of trade were really low back then when the dollar was 65 to 70 or 75 cents. So the 25% rise, remember the dog, you know, on the leash, so they are kind of tied together long term. There's a chart in the January Monetary Policy Report which illustrates it. Point is that that's an irresistible force, okay? So around that, there can be these other things. You say, well, you have a bit of a, you know, volatility in India or Kazakhstan or wherever. We're in an environment which is a lot of things aren't quite happening as normal, right? And so you get these periods of volatility where things can move a lot, and I understand it can make quite a challenge for exporters when the price can swing like this. That's just one of the things we have to take. And the point of my speech is that those undercurrents will remain. Even as the recovery gets stronger, the U.S. gets stronger, and our economy is picking up, the underneath that terms of trade thing will still be there. So we'll still have, you know, hotter markets in Canada and cooler markets in Canada. Those adjustments take years to work themselves out because they mean people have to move across the country. So I'm just trying to make you aware that they don't just disappear just because the recovery gets more real. I'm not going to predict where the dollar is because the dollar is going to be where it goes. We can be clear on the story. And folks that, trade in foreign exchange markets, kind of trade, and then the dollar gets ground out. And all we try to do is offer you a credible analysis of then what it means for us, as opposed to what it's going to do.
Appreciate that. I see, Governor, we have somebody at the first mic. If you could identify yourself, please.
My name is Fred Smith, and I'm a newly minted senior citizen here in Canada. So I spent my working lifetime in the 70s, in the high inflation era of the 70s and 80s. So I was struck by your comments on inflation. So I was wondering whether you thought in your working lifetime you would have to deal with the problem of low inflation, whether that would be a problem for you. And could you explain why low inflation is a problem in today's economy?
Sure. Of course, we're all raised to believe that high inflation is a problem. And it's particularly a problem in the sense that it distorts decision making, it erodes your purchasing power, your pension plan doesn't work out as intended, that kind of thing. So back over 20 years ago, a consensus emerged among central banks that we should just target inflation. And everybody picked around 2%. It wasn't just arbitrary. It was judged to be the lowest that you could do while taking into account the potential for measurement bias and the risk that in a big problematic period, inflation could get pushed down below zero. So the 2% is meant to be kind of a buffer zone, if you like. And what we discovered after the 2008 crisis is that for many countries, that 2% buffer wasn't big enough. So interest rates actually went down to zero. And ideally, they probably should have gone down lower. But of course, zero is a zero lower bound. And so in order to get ourselves out of that bad shock, central banks are driven to do extraordinary things like quantitative easing in the US and forward guidance, that sort of thing. So the point is that illustrates well the value of the 2% buffer. We don't expect another once in 100 years shock like that, and we've managed reasonably well through it. But going forward, we need to get inflation back up to 2% so we restore that buffer. So interest rates are at a level that allows us to adjust one way or the other to the next shock that comes along. So that's the concern, of course, is if inflation gets pushed down really close to zero or below zero, that you get kind of the Japan type of scenario. That's where you kind of get trapped there. And the reason it's really bad is because people's mortgages and companies' debt are denominated in current dollars. And if you have negative inflation, it means that your cash flow is shrinking or your wages are shrinking relative to the debt that you owe. And that gives rise to a really bad, we call a deflationary trap. People stop spending money. Banks, of course, have lots of problems like we saw in Japan. So the deflationary zone is something we all want to avoid. And getting back up to 2% on our target is all about making sure we don't get blown that far off course. If you're crossing a lake in a boat and you get pushed off to starboard, what are you worried about next? You're trying to correct, to go back. What you're worried about is that the wind will blow you even further off, right? So if the wind shifted and it blew you back towards it, that would be just fine. So for us, if the U.S. were to suddenly get much stronger than we expect, that would be really good news because that would help us shift gears back to our target. Does that help you, Fred?
Good. I think we have two more questions. The back microphone first.
I should mention that Lionel told me he would pay me $1 for each question. He said that there would be lineups at the microphones. And right now I'm only up to actually $2, and one of them is his.
I have 7 more questions, though, just so you know.
Oh, okay.
Back
Yes.
corner?
Back, okay.
Okay, and maybe I'll ask 2 questions just briefly.
Excellent.
Jordan Goff from STEP. We were fortunate enough to have the Bank of Canada, Mr. Tiff Macklem, here about a year ago. Mm-hmm. And one of the important exporting sectors or segments he spoke about was the export of services. And now there's not as much data that's visible on that area. Just interested, what's the Bank of Canada seen as far as growth in that sector?
Well, it has, in fact. I referred in my talk to commercial services, which is the main bucket, but tourism and travel services is another big one. And both of those are actually quite exchange rate sensitive. You'll be interested in a study we're posting at the same time as my speech, which breaks down the categories into the 31 export subsectors. So it'll be on the web by the time you leave the room. It's probably there now. And so what we've done is cut the data in two ways. Have they been tracking their fundamentals? Number one, because we have this wedge, which suggests that exports have been underperforming growth in the U.S. Well, it turns out that the wedge is only for about half of the sectors, and the other ones have been performing really well. We normally model this in a very aggregate way. So, and there's another cut of the data that about half of the sectors, some in both categories, have historically been highly sensitive to permanent changes or long-lasting changes in the exchange rate. So that 10% decline from the peaks, we expect to get some movement in some of those sectors. This still leaves us with about half of our export volume still struggling. So it's not all good news, but it's a bit deeper understanding of it. Services have been a hot category, tracking well, and it's where we'd expect to see pulled up. As the U.S. recovery becomes more broadly based, it'll capture investment. Firm B2B kind of business, that's where that really hits.
Sure.
Other important questions. We just want to make sure, have there been any unsolicited phone calls from the Bank of England to you?
Well, we confer on a regular basis, actually.
Very good.
We have dinner together almost every month over in Basel.
Sure, very good. Good, sir?
Thank you. Derek Shevkenik. Speaking about inflation, actually there's something that's it's kind of annoyed me a little bit, I suppose. On the website, it says, and has for a number of years, we are Canada's central bank. We work to preserve the value of money by keeping inflation low and stable with that 2% target. It's just that at that target, in 11 years, the value of money has dropped by 20%. And so I appreciate your comments in terms of what you're trying to manage and balance, but that statement just doesn't make sense to me. And then sort of fundamentally with regards to inflation itself, really interesting exchange in 2008 at these hearings down with this hearing with a congressman was asking previous chairman Ben Bernanke. The congressman states, I maintain inflation as a tax, and you're probably the biggest taxer in the country, along with other comments relating to price increases and so on. And Ben Bernanke replied, Congressman, I couldn't agree with you more that inflation is a tax. And I'm just wondering, that was such an interesting exchange. Would you agree with Mr. Bernanke or not? And I'm curious why or why not.
Well, I have no doubt it'd be hard. There are almost no things in which Ben Bernanke and I would disagree. Right? So we'll start there. But so in theory, that's absolutely true. It's mechanically true that inflation is a tax because it robs a little bit of your purchasing power every day. We know that. But as I mentioned before, in practical terms, having a target for inflation of 0, which is the same thing as targeting the price level, which I think may be the only thing that might satisfy you, is extraordinarily difficult and brings along with it the danger that when there is an exogenous shock to the economy, usually from outside the country, but not always, that we have no room to maneuver to adjust to it. And that's important too, because the world is not steady rock. If you look at our success over 20 years of inflation targeting, the average has been almost exactly 2% over that period, which is an extraordinary success given all the things that have happened. But of course it zigzags a lot. That's the kind of, if you take all that volatility in inflation and somehow compressed it to 0, all that volatility would be realized in other things in the economy that you care way more about. So, for instance, unemployment rates would be zigzagging around much more. We'd have lots of short but hard recessions and booms instead. So these are things that were all went into that analysis back when I was my first time at the bank, when we were deciding that an inflation target was the way forward. It's about not just keeping inflation on target, but minimizing the other downsides, the volatility to things that matter even more. So all those things are trade-offs. There's no yes, no, maybe so. It's of course a gray zone. But that's the best thing that we've got going for us. And we've analyzed things like price level targeting. Each time we renew, it's a 5-year commitment that we have with the government. And each time those kinds of frameworks come up short. Flexible inflation targeting is what we worked through in the past 5 years since the crisis. And I think considering we came that close to really, really bad outcome, I think it did really well for us.
Thank you. One quick follow-up to that.
Oh, this is going to cost $1.
Yeah. I thought you wanted to earn more dollars there. But it's with regards to if on the inflation measure itself, if inflation was calculated apples to apples today the way it was back the last time, as the previous gentleman was describing in the 70s when inflation was really high, how different would it be? Just because I know that there has been some fairly significant changes in calculation.
Well, there have been very significant changes in what you and I buy every day, and that's the main thing that has changed. So if we went back 40 years, you know, how many of you had 2 iPads and you know, video games for the kids and you know, a DVD player, and you know, on it goes. Like, you know, we didn't have you know, didn't pay $50 a month for web service. You know, there's all kinds of things in the consumer basket today that just weren't even thought of back then. So that's the main thing that changes through time. Methodology gets a little better, okay, because you do better surveys, you use web information to sharpen those things up, that sort of thing. So information's more available. So I would say we've probably made a better estimate of what inflation truly is today than 40 years ago. But the most important thing is you just buy different stuff. So it has to move to change to reflect that.
Thank you.
All right.
Yeah, thank you.
Well, ladies and gentlemen, thank you very, very much. This has just been a wonderful opportunity. If you don't mind, I'd love you all to give a warm hand to Governor Poloz and the great work that he's done. As is our tradition, we will give you a memento of Saskatchewan, so the next time we come and see in your office, you'll have a sense of what Saskatchewan's supposed to be. Ladies and gentlemen, again, I'm proud to...
Thank you so much.
Thank you very much, Governor.